My name's Chris Parsons, and I teach in the finance department at the University of Southern California Marshall School of Business. And today I'm going to talk about municipal bond markets, and in particular ask whether municipal bond markets for college traded bonds can teach us anything about racial discrimination. So what's the big issue in the discrimination literature? So you're trying to figure out whether there's discrimination between two groups of people. It could be black, white, men, women, old, young, any group that you're interested in trying to isolate discrimination. The big issue in this literature is the observation that correlation is not the same as causation. Here's an example from the health literature. So the investigators compared the diets of vegetarians and meat eaters and looked at longevity. So what they found overall was that vegetarians had about a 12% chance, less chance of dying every year. This was all-cause mortality. If you look at these various different causes, it was about the same thing. However, what the investigators also found is that vegetarians and meat eaters differed in ways other than their diets. For example, vegetarians were more likely to be married. Turns out that being married is related positively to longevity. They're also more likely to be educated. Education, it also turns out, is related to longevity. So at least some of the 6 to 9 extra years of life aren't due to dietary differences, but to other stuff known to influence longevity. That's an example where you can't necessarily conclude, oh, I'm going to give up meat because it's going to make me live longer. Most of the effect in this study came from other stuff that's correlated with living longer. The same issue shows up when studying race. So this is Roland Fryer's relatively famous paper on the police use of force published in the Journal of Political Economy. What he found is on the non-lethal use of force, blacks and Hispanics are more than 50% more likely to experience some form of force in interactions with police. However, adding controls that account for important context and civilian behavior reduces, but cannot fully explain these disparities. In other words, that 50%, that's just looking at the overall. Once he starts adding controls for the reason for the interaction, the neighborhood, things like that, about half to 2/3 of that 50% difference was explained by these contextual controls, still leaving some differences between black and white suspects or Hispanic and white suspects, but not as big as the overall findings. So to precisely estimate race effects, generally we need to be comparing situations where everything besides race is identical. Obviously in real life, you don't get situations like that. You take two people in a situation, other things are going to be different besides their skin color, their wealth, their age, their gender. And so this is a problem for social scientists generally. Finance offers an interesting approach to this problem. But first I want to talk about just a very brief primer on bonds. So if you're thinking about pricing a bond, which is what we're going to talk about in this paper, you're an investor standing at time equals 0 today. And I'm going to promise you $100 at time equals 1, time equals 2, time equals 3, and time equals 4. The question is, how much would you pay for that stack of four $100 promises? You would not pay $400, you'd pay less. So for that first $100, you might pay, say, 91. And for the second $100, you might pay, say, 83, and so on. So the combination of these, if each $100 is getting progressively less valuable, maybe you'd pay $317 in this particular example. This is the fair price an investor would pay for this bond today. And critically, financial markets are a little different than other markets. If you're buying a sofa, you care about the sofa, how it feels, how it looks in your living room, how it smells, how it just speaks to you aesthetically. That's not how stocks and bonds are. When you buy a stock or a bond or an option, all it is about the cash flows. You're not consuming the bond. You're going to use the cash flows from the bond to consume something that's consumable, like a meal or a massage or a convertible or whatever. So the only thing that matters to investors is money. Contrast this with other situations where you might be looking at racial discrimination, like labor markets or police suspect interactions. Lots of confounding factors. So what we're going to do in this paper is we're going to try to measure racial discrimination in a setting where we don't really think there's room for any other factors besides racial preferences to explain the findings. Here, what I've shown you is Mercer, which is a non-historically black college and university in Georgia, and Morehouse, which is a comparable otherwise but historically black college and university. Most historically black colleges and universities are distributed in the American South and Southeast. What we're going to look at is colleges in the same state and at the same point in time that both issue bonds. Colleges, it turns out, issue bonds to fund chemistry labs or dormitories or stadium improvements or faculty retention. There's all sorts of reasons why colleges issue bonds. So we're going to look at a Mercer bond and a Morehouse bond, or comparisons like that in other states, and ask whether investors treat these bonds differently, whether investors appear to avoid the Morehouse bonds and be more apt to invest in the Mercer bonds. We're going to focus on insured bonds in some of our tests, which ensure that essentially there's no credit risk. So the first thing you may be thinking about is, well, maybe HBCU colleges differ in terms of their financial credit worthiness. We're going to take that away by focusing on bonds that both colleges, both the HBCU and the non-HBCU, have purchased bond credit insurance, which means if for whatever reason the school weren't able to satisfy their debt claim, an insurance would step in. So an investor would never feel the default, even if there were one from the school. The summary of results is as follows. We're going to look at two things. First, we're going to look at the bond prices themselves, and then we're going to look at the selling commissions. I'll talk about that in just a second. If we look at the bond prices between Mercer and Morehouse, again, when I say Mercer and Morehouse, there's thousands of schools in our sample. I'm just talking about these two for the sake of illustration. There's a big difference. So Mercer bonds are a lot more pricey than Morehouse bonds if you don't include controls, for example, for the school quality or for the school, for how well known the school is to investors, the size of the school. Once you start adding controls for the bonds, like the maturity of the bond, the size of the school, the student body, the size of the endowment, most of that difference between the HBCUs and the non-HBCUs evaporates, not unlike Fryer's findings for police shootings between minority and white suspects. If we look at selling commissions, that's not the case. And when I say that's not the case, I mean the inclusion of controls does not change the findings to any meaningful degree. The selling commissions are far higher for the HBCUs than they are for the non-HBCUs. What do I mean by selling commissions? Bonds, you can think about them as being like houses. You can buy a house and you sell a house, but every time you buy and you sell a house, you have to use a real estate agent. Bond traders are the same way. Every time two investors, if I'm going to sell a bond to you, I'm not going to sell it directly to you. I'm going to sell it through an intermediary who's a bond broker. That bond broker is going to take a little commission, just like a real estate agent does. What we found in our data overwhelmingly is that the commissions that bond brokers, bond dealers take when they sell HBCU bonds are dramatically higher than they are for comparable non-HBCU schools. Why does that matter? And why does that make sense? Well, to get at that, we looked at some further tests, which is we compared the HBCUs in the Deep South. So here you're looking at Louisiana, Alabama, and Mississippi, compared to HBCUs that are located, for example, in Missouri, Virginia, or North Carolina. Our idea here was the following. Suppose that what happened was an investor sells an HBCU bond to a bond dealer. That bond dealer anticipates that it's going to be difficult for him to find a willing buyer if that happens to be in the Deep South, Alabama, Louisiana, Mississippi. If there aren't a lot of investors willing to step up and buy an HBCU bond for fair value, eventually the bond dealer will get his price or her price, but it's just going to take a long time. It's going to take a lot of selling effort. So getting back to the real estate example, the real estate agent might have to hold 15 open houses rather than 2 to sell the house. The bond dealer is going to demand compensation for that in the form of a higher selling commission. So we compared the differential selling condition between the HBCU school and the non-HBCU school in the Deep South compared to outside the Deep South. And what you find is that for the non-HBCU schools, the selling commissions are basically the same in a place like Mississippi compared to North Carolina. For the HBCU bonds, it's dramatically different. So in states where there's less likely to be racial animus, now there's certainly racial animus in all US states, it's almost certainly going to be different in the Deep South than it is compared to a place like Virginia or Pennsylvania. And here, just going back to this map for a second, you can see I've superimposed on this figure here. This is the white vote share for Barack Obama in the 2008 election. And you can see through the Southeast, it was relatively low 20s and 30s, but in these 3 states, it was in the low teens. So that's what we think we're capturing there is the unwillingness of white voters in those particular states to vote for an African-American candidate. That's the same thing that we think might lead them to be reluctant to buy HBCU bonds. And that's exactly what we find in the data. So the overall results, the headline results for this paper are that when you look at the prices of bonds comparing HBCU schools and non-HBCU schools, you do find modest price differences, but most of the effect of what we interpret as being racial discrimination by bond investors shows up in the selling commissions or the search costs that underwriters have to pay to place these bonds. We care about these results for a couple of reasons. One is that we care about HBCUs generally by virtue of the fact that they serve an underrepresented group of potential college students. More generally, though, we think our findings have implications that economists should care about in the labor market generally. Specifically, that is to say, if you look at two workers that work in the same job and appear to have the same wage, that's not necessarily the end of the story. Think about two workers that work in the same business, one of whom is white, one of whom is black. They make essentially the same wage, but it took the white worker 6 weeks to find employment. It took the black worker 6 months to find employment. Is there discrimination? Well, it depends on where you look. If you look at the entire chain, there would be. So I'll essentially leave you with the main takeaways. Even in a relatively pure setting, financial markets, where only cash flow should matter, we still find some evidence of racial discrimination playing a role in a market where we really don't think there should be much room for that. The effects are relatively modest looking at prices. They're larger looking at selling costs and search costs. We didn't talk about this so much in the presentation, but this is a setting where the effects on yields or bond prices can't be that large because there would be investors from other states or other countries that would come in and arbitrage those away. But I'll say it this way, the effects are about as big as they plausibly could be in financial markets. And the final point that I'll offer as a takeaway is that it's tricky to measure the all-in costs of racial discrimination. Going again back to the point of just looking at the prices of two bonds doesn't necessarily imply that those bonds are treated the same if you look at search costs, if you look at inventory costs. The analogy to the labor market, of course, is just looking at wages doesn't necessarily tell you the entire story if you consider things like search costs and time between jobs. Thank you.